If you're getting ready to sit for the Arizona state portion of your life insurance licensing exam, you're in exactly the right place. This video covers only what is specific to Arizona: the laws, the numbers, and the rules that the Arizona exam tests, and that differ from the national material you're studying somewhere else. We're going to assume you already know the national fundamentals: what term insurance is, how whole life builds cash value, what a beneficiary does. Keep studying those on their own. What we add here is the Arizona layer that turns a passing-on-paper candidate into someone who actually walks out with a license. Arizona has a handful of distinctions that show up again and again on the exam: a continuing education rule that's the heaviest in the country, an annuity protection for seniors that most states don't match, and a license that runs on a clock you've probably never seen before. We'll hit every one of them. By the end, the Arizona-specific numbers will feel automatic. Start with who's in charge, because the exam expects you to name them correctly. In Arizona, insurance is regulated by the Department of Insurance and Financial Institutions. You'll see it written as DIFI. That name matters because Arizona folded its old standalone insurance department into a combined agency that also oversees banks and financial institutions, so the answer the exam wants is the Department of Insurance and Financial Institutions, not just a Department of Insurance. At the head of it sits the director, who enforces the insurance code, issues and revokes licenses, investigates complaints, and can levy penalties. When a question asks who has authority to discipline a producer or approve a rate in Arizona, the answer points back to the director. The actual rules live in two places, and it helps to know which is which. The statutes, the laws passed by the legislature, are in the Arizona Revised Statutes, Title 20. When you see a citation like 20-1203, that's a Title 20 statute. The regulations, the more detailed rules the department writes to carry out those laws, live in the Arizona Administrative Code, Title 20, Chapter 6. Those are the ones written as R20-6, followed by a number. Statutes and regulations work together. The statute sets the requirement, the regulation fills in the how. You don't need to memorize citation numbers for the exam, but you do need to recognize that Title 20 is the insurance law and that the director under DIFI is the enforcer. So that's the lay of the land. DIFI regulates, the director enforces, and Title 20 plus its administrative code hold the rules. With that frame in place, let's walk through how you actually become licensed in this state, because Arizona does a few things its own way right from the start. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Here's something that surprises people coming from other states. Arizona does not require you to complete a state-mandated pre-licensing education course before you sit for the exam. Many states make you finish a set number of classroom or online hours first. Arizona lets you schedule and take the exam whenever you feel ready. Study however you like, and clearly you're doing that right now, but there's no hour requirement standing between you and the test date. That's a genuine Arizona difference worth filing away. The exam itself is administered by PSI Services, usually just called PSI. You schedule it through PSI, and you can take it either at a test center or remotely with online proctoring from your own computer. To pass, you need a score of 70%. We'll say that again because it's the number people ask about most. 70% is the passing score, and you find out whether you passed the moment you finish. Now, the retake rule, because Arizona writes this one into statute, and the exam likes it. You are allowed a maximum of 4 attempts to pass an exam within a 12-month period. If you fail 4 times in that window, you must wait 1 full year from the date of that 4th failure before you can try again. 4 attempts in 12 months, then a 1-year lockout. On your exam, If a question asks how many times you may attempt the test in a year, the answer is 4, and the consequence of a fifth-in-a-row failure is a 1-year wait. Once you pass, you're not licensed yet. You still have to apply. 2 timing numbers matter here. First, you must submit your license application within 1 year after you pass the exam, or that passing result expires and you'd have to test again. 1 year to apply. Second, Arizona requires a fingerprint-based background check. Fingerprinting is handled through a vendor called FieldPrint, and there's a small fee for it, along with a separate FBI processing fee. A practical tip the state itself gives: don't get fingerprinted until after you've passed, since the fees aren't refundable if you don't. Then there's the license clock, and this is the Arizona oddity you'll want to lock in. In most states, a producer license runs for 2 years. In Arizona, your license term is 4 years, and it expires on the last day of your birth month. The very first license you're issued runs somewhere between 3 and 4 years to line you up with that birth month expiration, and every renewal after that is a full 4 years. So picture someone born in March. Their Arizona license will always expire on March 31st, 4 years at a stretch. If a question hinges on how long an Arizona license lasts, the answer is 4 years, tied to your birth month, not the 2 years you may have seen in national material. And if you let it lapse, Arizona gives you a grace window. For up to 1 year after expiration, you can still file a late renewal by meeting the requirements and paying an extra $100 late fee on top of the normal renewal. Let's recap the licensing numbers before we move on, because several of them are favorites on the exam. No mandated pre-licensing course, a 70% passing score, 4 attempts per 12 months, then a 1-year wait. 1 year after passing to apply. A 4-year license term expiring the last day of your birth month, and a $100 late fee within the 1-year late renewal window. Those 6 facts carry a lot of exam weight. That 4-year clock leads straight into the next topic, because a 4-year license means a 4-year continuing education cycle, and Arizona's continuing education requirement is unlike anything else in the country. Most states ask resident producers for around 24 hours of continuing education, usually over a 2-year cycle. Arizona asks for 48. A resident producer holding a major line of authority must complete 48 hours of continuing education during each 4-year license term, and at least 6 of those hours must be in ethics. Say those 2 numbers together: 48 total, 6 in ethics. It's the largest continuing education requirement in the country, and the reason is that 4-year cycle we just covered. The hours are spread across 4 years instead of 2, so the total is bigger. Whether you hold one major line or several, the requirement is the same 48 hours. Adding lines doesn't multiply it. A couple of details the exam can probe. Arizona doesn't allow carryover. Hours beyond the 48 don't roll into your next term, and you can't repeat the same course for credit in the same cycle. And you must finish your continuing education before you submit your renewal, not after. There's also a narrow exemption. A producer who has been continuously licensed in Arizona since January 1, 1995, who has never held a non-resident license in another state, and who has never been disciplined, is exempt from the requirement. That's a small, specific group, but it's the kind of carve-out a tricky question loves. On top of the general 48 hours, Arizona layers in special training tied to particular products, and these are separate triggers you should keep straight. If you want to sell annuities, you must first complete a one-time 4-hour annuity training course before you solicit or sell any annuity product. One time, 4 hours, upfront, and we'll come back to annuities later, because Arizona pairs that training with a tough standard of conduct. If you want to sell long-term care insurance, you complete an initial 8 hours of long-term care training, then 4 more hours each license term to stay current. And if you sell flood insurance, there's a one-time 3-hour flood course. These special training hours can generally count toward your 48, but the triggers themselves are product-specific, so think of them as keys. No annuity key, no annuity sales. To lock the section, 48 hours of continuing education every 4-year term, 6 of them ethics, no carryover, finished before renewal. A one-time 4-hour course before you sell annuities. An 8-hour then 4-hour path for long-term care. If you remember nothing else here, remember 48 and 6. Knowing the rules to keep your license is one thing. The exam also tests the rules for how you behave while you hold it. So let's turn to producer conduct and the practices Arizona forbids. Arizona, like every state, prohibits a set of unfair trade practices, and the exam expects you to recognize them by name. We'll define the ones that get tested most. Misrepresentation means making false or misleading statements about a policy's terms, benefits, or an insurer's financial condition. You can't dress up a policy as something it isn't. Rebating means giving a client something of value not stated in the policy as an inducement to buy. A kickback, a portion of your commission, a gift outside the contract. In Arizona, rebating is prohibited. Defamation means making false, malicious statements about another insurer's financial standing. Coercion and boycott involve using pressure or force to control how insurance business is placed. Each of these is its own violation, and the exam likes to give you a short scenario and ask you to name which one occurred. Here's a scenario to make rebating concrete. A producer tells a prospective buyer, "Sign with me today, and I'll personally cover your first month's premium out of my own pocket." Has the producer done something wrong? Yes. That's an inducement to buy that isn't part of the policy, and offering it is rebating. The fact that it helps the client doesn't save it. Arizona prohibits it because it distorts fair competition and pricing. A few more conduct rules with Arizona specifics. Records. An Arizona producer must keep the usual records of insurance transactions and retain them for 3 years, available to the director on request. 3 years is the retention number. Commission sharing. You may only share or pay commissions with someone who is properly licensed for that business. You can't split a commission with an unlicensed person. And insurable interest. At the time a life policy is issued, the policy owner must have a genuine stake in the continued life of the insured, whether that's love and affection in a family or a financial interest in a business partner. Tied to that, Arizona prohibits what's called stranger-originated life insurance, arrangements where an investor with no real connection to the insured engineers a policy purely to collect the death benefit later. No insurable interest, no valid policy. One more, and it connects to a topic we'll cover in depth. You may not use the existence of the State Guaranty Fund as a selling point. We'll explain what that fund is shortly, but the conduct rule is that advertising or promising, don't worry, the State Guaranty Fund has your back. To close a sale is a prohibited practice. The protection exists. Using it as bait does not. So the conduct picture is this: no misrepresentation, rebating, defamation, and coercion by name. Keep records for 3 years. Share commissions only with the licensed. Honor insurable interest and reject stranger-originated schemes, and never sell on the Guaranty Fund. With conduct covered, we move to the heart of the exam's Arizona content, the policy provisions, where the specific day counts live. This section and the next are where Arizona pins down the exact timeframes inside a life policy, and these are the most heavily tested numbers in the whole exam. We'll go slowly and repeat each one. Start with the grace period. The grace period is the stretch of time after a premium due date, during which the policy stays in full force even though you haven't paid yet. In Arizona, the grace period on a life policy is 30 days. 30 days. If the insured dies during those 30 days before paying, the policy is still in force and the death benefit is payable. The insurer simply subtracts the overdue premium from the proceeds. Here's a spoken scenario. A premium is due on the 10th of the month and isn't paid. On the 28th, 18 days later, the insured dies. Is the benefit payable? Yes. 18 days is inside the 30-day grace period, so the coverage held, and the insurer deducts that one overdue premium from what it pays out. Arizona's 30 days lines up with the common national norm here, so this is one number you won't have to unlearn, but know it cold, because the exam tests it directly. Next, reinstatement. Reinstatement is bringing a lapsed policy back to life after the grace period has run out and the policy has actually lapsed. Arizona's life insurance statutes set the reinstatement window at 2 years from the date of premium default. To reinstate, the policy owner has to do several things: apply in writing, show evidence of insurability, meaning prove they're still healthy enough to qualify, and pay all the back premiums with interest, along with any outstanding policy loan. One limit to remember: you cannot reinstate a policy that's already been surrendered for its cash value, because once you take the cash, the contract is gone. On your exam, the trap is mixing up grace and reinstatement. Grace keeps a barely late policy alive with no health questions asked. Reinstatement revives a fully lapsed policy and does require proof of insurability and back premiums with interest. Different stages, different rules. Now, incontestability, which is a consumer protection. The incontestability provision says that after a policy has been in force for a set period during the insured's lifetime, the insurer can no longer contest it or deny a claim based on a misstatement or omission in the application, fraud included, for ordinary purposes. In Arizona, that period is 2 years from the date of issue. 2 years. After 2 years, the insurer is locked in, with one standing exception. Non-payment of premium is always a valid reason to end coverage, contestable period or not. Picture a policy issued and the insured dies 2.5 years later. The insurer discovers the application understated a health condition. Can the insurer deny the claim on that basis? No. The 2-year incontestable period has passed, so the policy stands and the claim is paid. Closely related, and often confused with incontestability, is the suicide provision. Arizona allows a life policy to exclude death by suicide if it occurs within 2 years of issue or reinstatement. If the insured dies by suicide inside that 2-year window, the insurer generally returns the premiums paid rather than the full death benefit. After 2 years, suicide is covered like any other death. Notice that both incontestability and the suicide exclusion run 2 years in Arizona. Same length, different purpose. Incontestability protects the insured from the insurer reopening the application. The suicide clause protects the insurer from someone buying a policy intending to die soon. The exam will sometimes test whether you can tell them apart, even though the clock is the same. Last in this group, misstatement of age. If the insured's age is stated wrong on the application, Arizona doesn't void the policy. It adjusts the benefit. The death benefit is recalculated to the amount the premium actually paid would have purchased at the insured's true age. State the age too young, the premium was too low for the coverage, so the payout is reduced to match. It's an adjustment, not a cancellation. Let's recap the day counts and the year counts you must lock in from this section. A 30-day grace period, a 2-year reinstatement window with evidence of insurability and back premiums plus interest, a 2-year incontestable period, and a 2-year suicide exclusion. 3 of those are 2 years, 1 is 30 days. Keep the 30-day grace separate from the trio of 2-year rules, and you've got it. Coming up next, the rest of the policy provisions, including a free look window that's shorter than some states give, and the deadline by which Arizona makes insurers pay a death claim. The free look comes first. The free look provision, Arizona also calls it the right to examine, lets a new policy owner return the policy for a full refund within a set number of days after delivery, no questions asked, as if the policy never existed. For life insurance in Arizona, that window is 10 days. 10 days from delivery to change your mind and get every dollar back. Some states give 20 or 30. Arizona's standard life free look is 10. So if you studied a longer number nationally, reset it here. Hold on to that 10-day figure, because in a moment, when we reach annuities, Arizona changes the rule in a way that rewards older buyers. And the contrast is a classic exam setup. Claims payment is next, and Arizona puts a clock on the insurer. Once the insurer has the paperwork it needs to pay a death claim, it must pay within 2 months. If it drags past the deadline, Arizona requires it to add interest to the payout. running from when the insurer received proof of death. So the structure is pay within 2 months and pay interest if you're late. The point of the rule is that a beneficiary who's already grieving shouldn't also be financing the insurer's delay. A quick pass through the remaining provisions because the exam touches them. Policy loans, a whole life policy with cash value lets the owner borrow against it, and Arizona caps the interest rate the insurer can charge on that loan. The loan reduces the death benefit until it's repaid. Non-forfeiture options. If an owner stops paying on a policy that has built cash value, they don't simply lose everything. They choose among non-forfeiture options, taking the cash surrender value, converting to reduced paid-up insurance for a smaller permanent amount, or using extended term insurance that keeps the full face amount for a limited time. Those options exist in every state, but Arizona requires them by statute, so recognize them as guaranteed rights, not insurer favors. Recapping this section, a 10-day life-free look, claims paid within 2 months or interest accrues, statutory policy loan interest limits, and guaranteed non-forfeiture options when a cash value policy lapses. The headline number is the 10-day free look. Say it back to yourself, because annuities are about to bend it. But first, a topic where Arizona is strict about how you move a client from one policy to another. Replacement means convincing a client to drop or change an existing life policy or annuity and buy a new one in its place. Arizona regulates this carefully because replacement can quietly hurt a consumer. A new policy can restart the contestable and suicide clocks, trigger new costs and surrender charges, all while the producer earns a fresh commission. So Arizona imposes duties whenever a sale involves replacement. When you're proposing to replace existing coverage, you must, at the point of sale, give the applicant a written notice that lays out what replacement can cost them and lists the existing policies being replaced. Arizona builds this on the National Model Regulation forms, so the document is a standardized important notice about replacing life insurance or annuities. You provide it, the applicant signs it, and it goes on record. The purpose is informed consent. The client should understand exactly what they're giving up before they let an in-force policy go. Alongside the replacement notice, Arizona also expects the buyer's guide and policy summary to reach the consumer, so they can compare what they have against what they're being sold. On your exam, a replacement scenario usually tests whether you recognize that special disclosure is required and that the producer can't just swap policies quietly. If a question describes a producer moving a client into a new policy without the replacement notice, that producer has violated the rule. Recap. Replacement triggers a mandatory written notice and disclosure at the point of sale, listing the existing coverage, so the consumer consents with eyes open. That theme of protecting the consumer carries directly into annuities, where Arizona goes further than most states. Remember that 10-day life-free look from earlier? Here's where Arizona does something distinctive, and the exam loves it. For an annuity, the buyer gets a free look window of 10 days. But if the buyer is 65 years of age or older on the date of the application, that window stretches to 30 days. 10 days normally, 30 days for a senior. Say that back. An annuity free look is 10 days or 30 days if the contract holder is at least 65. Arizona built in extra time specifically to protect older buyers, who are the prime market for annuities and the most exposed to a rushed or unsuitable sale. On your exam, watch for the age threshold. The magic number is 65, and the longer window is 30 days. If a question swaps in age 60 or 70, be suspicious. It's 65. If it offers 20 days, that's not Arizona's number either. Now the bigger Arizona development, and the reason that one-time annuity training exists. Arizona has adopted a best interest standard for annuity sales. Under it, when a producer recommends an annuity, the producer must act in the best interest of the consumer under the circumstances known at the time, without placing the producer's or the insurer's financial interest ahead of the consumer's. This is a step up from the older, weaker idea of mere suitability. It's the same modern standard built on the national model that states have been adopting, and Arizona is among them. The best interest standard breaks into 4 obligations, and they're worth knowing as a set. The care obligation: use reasonable diligence, skill, and judgment to understand the consumer's financial situation, needs, and objectives, and have a reasonable basis to believe the annuity effectively serves them. The disclosure obligation: tell the consumer, upfront and in writing, who you are, what you're selling, how you're paid, and the scope of what you can offer. The conflict of interest obligation: identify and avoid or manage conflicts, so a bonus or a sales contest can't quietly steer the recommendation. And the documentation obligation: write down the basis for the recommendation and keep it. Care, disclosure, conflict of interest, documentation. 4 obligations under one best interest umbrella. Here's a scenario. A producer recommends that a 70-year-old move a large, stable savings balance into a deferred annuity with a long surrender period the client may not outlive comfortably, mainly because that product pays the producer the highest commission. Does this meet Arizona's standard? No. Putting the producer's compensation ahead of the client's interest fails the conflict of interest and care obligations at the core of the best interest standard. And note, the client would also have that 30-day senior free look to escape, but the rule is meant to prevent the bad sale in the first place, not just unwind it. Recapping the annuity section, because it's dense and high value: an annuity free look of 10 days, extended to 30 days for a buyer 65 or older. A best interest standard governing every annuity recommendation, resting on 4 obligations: care, disclosure, conflict of interest, and documentation. And the one-time 4-hour annuity training you complete before you can sell at all. If the exam asks what protects an Arizona annuity buyer, those 3 answers cover it. Next, the safety net that catches consumers when an insurer itself fails. Insurers can become insolvent, financially unable to pay what they owe. To protect policyholders when that happens, Arizona maintains the Arizona Life and Disability Insurance Guaranty Fund. Every insurer licensed in Arizona to write life, annuity, or health business must belong to it, and the fund steps in to cover claims up to set limits when a member company fails. To be protected, you generally must be an Arizona resident at the time the company is found insolvent, and the failed insurer must have been licensed in Arizona. Now the limits, because these are tested dollar figures, and you should memorize them per person, per any one life. The fund covers up to $300,000 in life insurance death benefits. Within that, it covers no more than $100,000 in net cash surrender value for life insurance. For annuities, it covers up to $250,000 in the present value of annuity benefits. And for most health or disability coverage, the basic protection is $100,000. Let's say the headline numbers again: $300,000 for a life death benefit, $100,000 for life cash value, $250,000 for annuity value. The exam likes to swap these around, so anchor each figure to its product: $300 for the death benefit, $250 for the annuity, $100 for cash value. And recall the conduct rule from earlier, because the exam pairs it with this topic. A producer may not advertise or use the existence of this guarantee fund to sell or solicit insurance. The protection is real, but it is not a marketing tool. So the picture is a mandatory safety net with firm per-life caps: $300,000 death benefit, $250,000 annuity, $100,000 cash value that you must never turn into a sales pitch. With the safety net covered, let's gather up the remaining Arizona protections, several of which circle back to seniors. A few Arizona-specific items round out the picture, and they cluster around protecting consumers in higher-risk transactions. We already met the strongest senior protection, that 30-day annuity free look for buyers 65 and older, double the standard 10 days. It's worth repeating here because the exam returns to it. The senior annuity free look in Arizona is 30 days. Combine that with the best interest standard and the 4 obligations, and you can see Arizona has built a deliberate wall of protection around older annuity buyers. Then there are life settlements, sometimes called viatical settlements, arrangements in which a policy owner sells an existing life policy to a third party for a lump sum, typically less than the death benefit, but more than the cash surrender value. Arizona regulates this market and requires a separate license, a life settlement broker license, for someone who arranges these transactions on the owner's behalf, and that person must also hold or be applying for life producer authority. The exam may simply test that life settlements are regulated in Arizona and that brokering them requires its own license. Finally, variable products, variable life, and variable annuities, whose values move with investments in a separate account rather than being fixed. Because these are also securities, selling them requires more than an Arizona life license. The producer must additionally be properly registered to deal in securities and qualified under Arizona's rules for variable products. The takeaway for the exam is that a plain life license alone does not authorize variable sales. There's an added securities qualification layered on top. Recapping the special protections: a 30-day senior annuity free look, life settlements that require their own broker license, and variable products that demand an added securities qualification. Each is Arizona, drawing a tighter line around a transaction where a consumer could be hurt. That completes the substantive law. The last thing standing between you and a confident test day is knowing exactly what the exam itself looks like. Let's talk about the test you're actually going to sit, because knowing its shape calms the nerves, and a few of these details are themselves testable. The Arizona Life Insurance Producer Exam is the Series 13 to 31. It contains 100 questions, and you have 2 hours to complete them. 100 questions, 2 hours. They're multiple choice, 4 options each, and they mix a national portion with the Arizona-specific portion you've been studying here. To pass, you need 70%. We keep repeating that number because it's the one that counts, 70%, and you'll see your result on screen the moment you finish, along with a breakdown showing how you scored in each content area. The exam is delivered by PSI, and you can take it either at a PSI test center or remotely with online proctoring from home, as long as your computer and webcam pass the system check. The exam fee for the Lifeline is $50, paid when you schedule. And recall the retake rule, because it bears repeating in this context. 4 attempts within a 12-month period, and a 1-year wait if you fail all 4. Plan to pass well inside that allowance. There's no penalty for unanswered questions beyond getting them wrong, so a steady pace, a little over a minute per question across 2 hours, leaves you time to think and still finish. After you pass, remember the earlier rule. Apply for your license within 1 year, and complete fingerprinting through FieldPrint once you've passed. Recapping test day: Series 1331, 100 questions, 2 hours, 70% to pass, $50 fee through PSI, in person or remote, with 4 attempts allowed in a 12-month window. Know those, and there are no surprises waiting for you at the testing center. You've now covered the entire Arizona layer, so let's do one fast sweep of the numbers that win points, and then you're ready. The regulator is DIFI, the director enforces, and the law is Title 20. Continuing education is 48 hours every 4-year term, 6 of them ethics, the heaviest in the country. Your license runs 4 years and expires the last day of your birth month. The grace period is 30 days. Reinstatement runs 2 years, with proof of insurability and back premiums plus interest. Incontestability is 2 years, and the suicide exclusion is 2 years. The life free look is 10 days. Death claims are paid within 2 months, or interest accrues. The annuity free look is 10 days, or 30 days for a buyer, 65 or older, and every annuity recommendation must meet the best interest standard. The Guaranty Fund covers $300,000 for a death benefit, $250,000 for an annuity, and $100,000 for life cash value. And the exam is 100 questions in 2 hours, passing at 70%, with 4 attempts a year. Mix those up and you'll lose points. Lock them in, and the Arizona portion becomes the easy part of your day. You clearly have the discipline to get here and work through it all. And that same discipline is what carries people across the passing line. Go get the license. If this breakdown helped you, give it a like and subscribe so it can help the next person studying for their state exam, and good luck on test day.